All right, so here we're going to be looking at the last two sections of chapter 11. Well, in this case, 11.3 is going to be talking about the last depreciation method, which is called straight line. And then 11.4 is where we actually talk really briefly about amortization. Now, of course, the reason why I paired these up together at the very last section here is because straight line, more or less, once you learn and understand how to calculate straight line, amortization is the same rules as straight line. So I thought it'd be a good way to just pair these two together, okay? Because you learn one concept, you'll know how to do the other. Okay? So again, we talked about having the 5 components of to solve for depreciation, right? It's going to be the same 5 components throughout all the depreciation methods, right? You're going to have your asset cost. This time, we're going to be using the estimated useful life, okay? So similar to double declining. Salvage value, the date that you placed in service, because in this case, we are looking at partial years, and of course, the depreciation method itself. Now, of course, we exhausted every single method that we looked at, right? Again, I'm only teaching you 3 out of the 6. So this is the very, very last concept and the very last one that we're going to show you. And this is the one that's commonly used throughout most businesses, okay? Especially corporations, because it makes it that much easier to calculate. It makes it that much easier to just to calculate one number and just be done with the whole thing. All right? And what does that even mean? Well, I'm gonna go ahead and show you, right? Just like in its title itself, straight line, right? And what does it mean? Well, in this case, we're gonna take an asset, right? We know that when we solve for the cost of the asset, what we're gonna do is we're going to spread the cost amongst its total estimated useful life evenly, meaning that every year you're going to depreciate the same amount every single year to eventually, when you reach the end of its life, it pans out evenly perfect. So that means we're only really calculating maybe 1 or 2 numbers. But that's the thing about straight line is it's literally going in a straight line. You solve for one number and you're going to be constantly taking that same amount over and over and over and over again. So that's why I mean this one is going to be very fairly easy, because if you can solve for one, you pretty much have solved the whole entire thing, right? So here, the formulas are going to be a combination between units of production and double declining, okay? So let's take a look at depreciation basis, right? The depreciation basis is the cost of the asset minus salvage value, which is the depreciation basis that we solved in units of production, right? Then the depreciation rate is going to be 1 over its estimated useful life, which we know from double declining, except this time we're not going to multiply it by 2 because we're not depreciating it twice as much. We're only doing it once, okay? And then, of course, the depreciation expense is going to be basis times rate, and the last 2 equations will never change between whatever method that you use. It's right. Accumulated is always going to be your previous years plus your current year's expense. And of course, your book value will always be your asset cost minus your accumulated depreciation. So in this case, right, that is why I left straight line to be one of the last concepts, because it's kind of a mix between the first 2 that we just looked at, right? A little bit of units of production and a little bit of double declining to create what's called straight line, right? So let's go ahead and dive right into our first example, where we have an asset where we bought a machine and the cost of it was $15,000. And again, its salvage value was $2,500. Its useful life is 5 years, and the number of units that it could produce is 10,000. And the date that we placed into service was January 1st, okay? So already right here, we have our components that we need to be able to solve for our depreciation. So in this case, right, because we placed it in service as of January 1st, and our assumption is that we do the depreciation at the end of the year, right? It's an adjustment entry, which happens at the end of a given period. In this case, we're going to do it by years. So in this case, if we're going to start on January and we're going to end on December 31st, that's 1 full year. So in this case, this one's going to be a very, very easy example. So let's solve for the depreciation basis, which is the asset cost minus salvage value, which in this case is 15,000 minus 2,500 to give you 12,500. And again, the rate here is going to be 1 over its estimated useful life. So 1 divided by 5 will give you 20%. Okay, 0.2, which is the same thing as 20%. Okay, so now we have to figure out what the depreciation rate times the basis is. So 12,500 times 20% should get you a total of 2,500. Right? And of course, when we solve, the accumulated is the same because this is the first year that we're depreciating it. So our assumption is it's going to reflect because there is no previous years. And of course, we need to solve for our book value. So 15 minus 1250 gives you, 15 minus 250, 2,500 will get you 1250. Okay? And again, so on and so forth. So in this case, right, because my asset cost is always going to be 15,000, my formula for the depreciation basis is always going to be your asset cost minus salvage value. We're not going to be looking at book value. Okay, so in this case, we're going to ignore book value. Okay? And what's going to happen is, what happens when I solve for the next one? Well, let's solve for the depreciation basis again. Cost of the asset minus salvage value, which is 15 minus 2,500, gives you 1,250. Estimated useful life is still 1 over 5, which is 1 over 5, which gives you 0.2 or 20%. The basis times the rate, so 1,250 times 20% is still going to get you the same exact number all the way through. So this is what I mean by, well, this is what it means to spread the cost out evenly amongst its entire useful life. In this case, right, the more that we keep doing it, you're going to realize you're going to notice a trend. Your depreciation basis, your rate, and your expense are all going to be the same. All right? And then notice this. At the end of the 5th year for the accumulated depreciation should equal your depreciation basis. And once again, your book value should equal salvage value. So once again, when we realize that we have this trend, so when we solve for one row, we'll solve the second row, and then we'll solve for the third row, which they're all identical. So in this case, the only number that we're really calculating is just the accumulated depreciation and the book value. Okay. Now in this case, since the salvage value cannot fall below, or book value cannot fall below salvage value, in this case, you will always get the same. You will never go. You will never fall below or above salvage value anytime. You will hit salvage value at all times because it's even. It's spread out evenly across all throughout its entire life of 5 years. So at the end of the day, you calculate one number over and over and over again, and it should equal to your salvage value at the end of the day because you have set up a depreciation basis to get you to where you need to be. Okay? So how do we journalize it? Same thing here. We're figuring out that you're still going to use the depreciation expense and have the accumulated depreciation, but this time the number is going to be 2,500. Well, what happens for year 2? Your journals are all going to stay the same every single year because you're depreciating of the same amount every year. So therefore, that's why it makes it that much more easier for especially IRS, because that way they can see, okay, you have a fixed asset, this is how much it could cost, And this is its estimated useful life. You're basically dividing the asset's cost and dividing it amongst its entire life, which in this case, 5 years. So therefore, you're spreading the cost evenly through every single year. So therefore, there's no real need to actually calculate every single year. You just calculate one number and boom, the rest is automatically filled for you. Okay? Any questions here?
No.
Okay. So, but here is where you'll have a slight difference in your beginning when you depreciate your asset for the very first year. When partial years becomes something that is something that comes into play, right? In this case, I bought a machine that cost a total of $10,000 with a salvage value of $2,500. Its estimated useful life is still 5. Its number that units it can produce is 25,000. But this time, the date that I placed into service was October 18. Now, if we remember the rules right, because it fell after the 15, therefore, we barely used it in the month of October. So therefore, we're going to treat it as if we are going to do it for the next month, which is going to be November and December. Now, that's assuming that at the end of the first year, you're going to be doing your adjustment entry at the end of each year. So therefore, if I place into service as of October 18, right, and I'm going to depreciate it for its first year, how old is my actual asset? In this case, right? Go ahead.
Oh no, I was gonna follow along. So it was just so this one we do it for the following month still because it's the 18th of October.
Correct. So that
Oh,
means you're only depreciating it for the month of November and December.
oh, okay.
Okay? So in this case, that means my first year, my asset is it's not even a year. It's only 2 months old. Right? So if that's the case, then you have to follow the same rules for partial years, because if I am really depreciating at the end of its year, and if we're treating our machines like it's our children, right? The day that they're born is the day that you actually start calculating how old they are. In this case, if I'm going to start depreciating as of November, it's only 2 months old, right? So in this case, I'm going to solve for the same standard stuff, right? So the depreciation basis, once again, is 10,000 minus 2,500, giving you 75. 1 over its estimated useful life, which is 5 years. So therefore, it's 20%. And if you multiply 7,500 by 20%, it gives you 1,500. But that's for the whole year. In this case, right, at least when we solve for here, at least we know the next time we recalculate this, it's definitely going to be for 1,500. But for the first year, it's only 2 months old. So that's where you have to actually refigure this number out, because we're treating our machines like we treat our children. It's December, it's only 2 months old. So therefore, we need to calculate so we understand how much partial years works. So in this case, it's only 2 months out of 12, which gives you either this much, or in this case, you could take your 1,500, multiply it by the 2 divided by 12 will give you the same answer as well. In this case, it will give you a total of $250. So that means that's just for the very first year, because that's how much it cost me, or that's how much I used it for the first year, right? Because it's only 2 months old. Okay. And of course, journalizing once again, because it's the first year, right? That's where this one's going to be different than the rest of the year, right? But every year after that, it's going to be the same, right? Any questions in regards to straight line? It's pretty easy, actually. Really easy.
Yeah. So on this one, since it was the 2 months, our first journal will be the 250, and then after that, it would be the 1,500 for the 20.
Correct.
Okay.
Correct. And it's going to be 1,500 until you reach the end of its life.
Oh, okay.
Yeah, correct. Okay. So now that we learn really quickly what straight line does, how is amortization any different? Well, let's go ahead and talk about what amortization actually does. So for depreciation, right? We understand that depreciation is for tangible assets, fixed assets, things that you can actually physically touch. Where in this case, right, what does amortization do? Amortization is another way of devaluing or representing that you're using intangible assets. Okay? So in this case, right? So if fixed assets is depreciation, intangible assets is to amortization. And same thing, right? Land is to depletion. Right? So they all do the same thing, same idea, where you're trying to find some kind of way to represent that you're using the item in a form of depreciation. But in this case, it's just another terminology. They mean exactly the same thing. So in this case, right, you use amortization when you want to depreciate intangible assets. All right, and those usually are like things like patents, right, copyrights, licenses, anything like that, right? Trademarks, logos, any kind of legal right usually is typically intangible. Now, of course, with that, there's a huge difference for this, because at the end, when you actually purchase a license or actually purchase a permit, right, it expires at the end of its life. There's no such thing as having a salvage value, right? Because we understand that when we purchase our intangible assets, whatever you purchased it for is what its value holds. Okay, so again, if you purchase something for $10,000, it's going to stay $10,000 until it reaches the end of its life, and then when you have to renew it, right? It doesn't hold its value of 10,000. Whatever you renew it and you put a price tag on it is going to be your new value of the intangible asset, right? We understand that, right? That intangible assets actually expire, all right? And you have to go to that process where you have to repurchase either a new right to it or a new license to it, or basically renew its contract so where it holds some kind of monetary value, all right? So with that being said, in this case, salvage value becomes inexistent because it doesn't apply to intangible assets. Now, of course, every patent, license, trademark, they all have all different types of numbers that you can do when it comes to a life, right? You can purchase a copyright for a year. You can purchase a license for 3 years. You can purchase anything. You could purchase a a a movie right or a license for 20 years, right? Especially for Disney. Disney, I believe their contracts are anywhere from 25 to even 50 years, especially their patents or their copyrights, right? It's going to be forever, and they always have this like long, extensive period of holding, value to it. But of course, they can license other companies such as Target to borrow their logo for a year or so, right? So in this kind of sense, right, there is no actual real number that comes with understanding the life of the existence of an intangible asset, because there's so many different ones that you can do, right? Again, I gave you an example. You could do a 1-year patent, a 3-year license, okay? But in this case, I'm just going to keep it nice and simple, nice round number, and I'm just going to call this 15. Let's just treat all intangible assets as if they have a lifespan of 15 years, okay? And let's go ahead and proceed. So, like I've mentioned before, amortization. You're going to basically spread its the cost of the intangible asset amongst its entire lifespan. So in this case, it's identical to straight line, except you got one number off, or in this case, you don't need one component, which is a salvage value because it ceased to exist. So everything else that you have, right? You have the cost of it, right? Whatever you purchased it at is going to be the cost of it. There's no other things that could be value to it, right? When you buy a patent, you don't need to ship a patent to your store. You just go to the legal office and sign the contract and say this is the value of my patent, right? There's no need to prepare a patent to be ready for service. There's none of that. All you need to know is what was the amount that it's valued at, or what did you pay for it, and that's it. That's the determining as your total cost of the asset, right? No salvage value is involved. And then again, we talked about the estimated useful life, right? In this case, you can't tell what it is. So I told you 15 will be the one that we use in class. So straightforward. Everything's going to be the same. And of course, the last component is understanding what kind of depreciation method you're going to use. Now, as I mentioned before, straight line and amortization are identical. The only difference they have between them is one has a salvage value and the other one doesn't. So that means the formula is all going to be the same, except for, of course, the notion that there is no salvage value. So that means for amortization basis, it's just going to be the asset cost, nothing to it. And of course, the amortization rate is going to be 1 over its estimated useful life. The amortization expense is going to be the basis times the rate. And of course, so on and so forth, everything else is going to look the same. Okay? So let's take a look at our first example here, where we bought a patent for $20,000. It's got a life of 15 years, and we placed it into service as of January 5th. Now, in this case, the date that you place into service also holds the same way too, except honestly, when you purchase a patent or purchase any type of legal right or something like that, the day that you buy it's going to be the day that you depreciate it. So in this case, I have it for January 5th. Okay, yes, the rule follows the same as depreciation, right? If it falls between the first 15 days, then yes, you've had the patent for quite some time. But if it falls after the 16th, then you're better off just calculating as if you used it primarily in the next month. So the same rule applies there too, right? But when we understand, when we purchase our patents or purchase our intangible assets, you depreciate it the day that you buy it. Okay. So here you go. Amortization basis is going to be the cost of the asset. So in this case, we already know it's $20,000 because that's what we originally purchased it for. Then we understand that the rate is going to be 1 over 15, which is again I believe it's 0.0667, something like that. It's about 6 3/4 of a 2/3 of a price. Right? And that's the rate. And of course, every depreciation expense is going to be the same every single time. So in this case, it's going to be the basis times the rate, which is the 20,000 times the 6.666667%, which gives you 1,333. And because in this case, right, I placed it in place in January, then my assumption is that is for what it's worth for every single year that I have to depreciate it for. Right? And so on and so forth, right? You're going to calculate the same thing as usual, right? In this case, my amortization expense for the accumulated. Since there is no previous year, since this is your first year, it's going to reflect whatever your current expense is. And of course, we're going to have to also mark up because every year that we have the patent, right, it starts to lose its value over time because, again, you're spreading its life, right? It expires at the end of the year. So again, and it doesn't start up at, it doesn't stay 10,000, right? Because at the end of the day, when you have to renew it, it's lost its value already. You need to go and put extra value into it. Okay, so there you go. So it's now $18,666.67. So again, how do we do the rest? Straightforward. If we could do one, you could do the rest for the rest of the years. Okay. Now here, how do we journalize it? Well, if I treat depreciation expense for my fixed assets and I treat amortization as my intangible assets, it's the same journal entry except using different terminology. This time I have amortization expense and I'm going to credit my accumulated amortization for this example. And it's going to be for whatever you calculate it for. Oops. Okay. For whatever you calculate it for. Okay. So again, any questions in regards to chapter 11? Once again, we took a look at straight line, right? Where we have a combination between the units of production and double declining. And we made it into some kind of nice and easy way to solve for depreciation. And again, straight line is determined by spreading its cost evenly amongst its estimated useful life. All right, and we understand amortization to be the same exact. However, amortization does not hold a salvage value because it expires at the end of its life. And on top of that, but we do know that you are going to treat amortization as if it's the same thing as straight line, except the only difference here is you have no salvage value. Okay. Any questions?
No.
All right, so let's go ahead and dive right in to our exercises here. Right? So I have exercise number 1 up here, where we're going to be completing both. We're going to do both scenarios or both different types of depreciation and amortization in this example right here. So number 1, okay, you purchase a coffee maker for $250 with no salvage value. Its estimated useful life is 5 years, and it could produce up to 25,000 pots. Okay, and of course you place this coffee maker into service as of January 12th. Okay, so we bought a coffee maker, right? For how much?
$250.
$250. Okay. What's the salvage value on this?
0.
Yes, we have no salvage value. And what was the estimated useful life?
5 years.
5 years. Okay, and when did I place this into service?
January 12th.
Okay, so what does that tell me?
That we're going to do it for the current month.
Correct. So in this case, assuming that you are depreciating at the end of the year, December 31st, let's go ahead and solve for each and every single one. So in this case, what is my depreciation basis?
The 250.
Good, right? It's your asset cost minus your salvage value of 0, which gives you 250. Wait, let me fix that real quick. So it's this one minus this one. Okay, 250. What's my rate going to be?
20%. The 1 divided by 5 years.
Good, which gives you 20%. So in this case, what's my depreciation expense going to be for the first year?
So it's 250 times 0.20, the $50.
$50, which in this case, Since it's our first year, we know it's going to be $50. So what's my book value going to be at the end of the first year?
So it'd be the 250 minus the 50 to
Mm-hmm.
give us 200.
Good. Excellent. Okay. So then what is going to be my what is going to be my depreciation basis for year 2?
200.
No, we're
Oh.
not using book value.
Oh, so it stays the same.
It
The
stays
250.
correct. It's going to be the same for all 5 years, right? What about the rate?
That stays the same as well.
This also stays the same. Okay. What about my depreciation expense?
That one will stay the same because the first two columns are the same.
Correct, right? Your depreciation basis and the rate is still, if they're the same, your result for calculating your depreciation expense is also going to stay the same. So in this case, you're depreciating $50 every year. So then the question is, what's my accumulated depreciation for the second year?
So previous year plus the current year. So it would be 100.
Good. Bringing my book value to be
300.
okay, we're not adding.
150. Where the 50 and the 100.
Good. Right? Because in this case, right, we're taking 250 minus 100 gives you 150. Right? So then what's my accumulated depreciation for the third year?
150.
150. Bringing my book value to be
100.
100. All right. My accumulated depreciation for the fourth year?
200.
200. Making my book value
$50.
$50. Last but not least, what's my accumulated for the fifth year?
250.
250, bringing my book value
to 0.
to 0. So that's it for straight line. Right? It's really simple, really easy. So in this case, right, we have our end goals where our the end of the fifth year, right? The ending of my accumulated depreciation matches my my basis. And again, my salvage value ends up being the same thing as my book value ends up being the same as my salvage value.
Okay.
Now, in this case, right, question number 2 asks, well, what was the adjustment entry for the first year?
The depreciation expense of $50.
Good.
And then the accumulated depreciation also for $50.
Good. Okay. So then question number 3 asks, record the adjustment entry for the second year.
So then it would look exactly the same. Oh no. Depreciation expense is still the $50. And then the second one.
You were right. It will
Okay.
look exactly the same. Good. All right. Okay. You ready for question 4?
Yes.
Okay. So this is dealing with a partial years. Now let's take a look at this one. Let's read it carefully, okay? You purchase a couch for $2,485, which includes all fees and taxes and shipping, whatever, okay? With a salvage value of $150. Its useful life is 7 years because it's furniture. And he's had to put this couch into service as of August 25th. Assume that the adjustments are made at the end of the year. Oh, sorry, at the end of the month. Excuse me, at the end of the month. Okay. So let's go ahead and fill in my information. So, what did I buy? I bought a couch.
Mm-hmm.
How much was the couch?
2,485.
2,485. Okay. What's my salvage value?
150.
150. Okay. What's my estimated useful life?
7 years.
7 years. And when did I place it in service?
August 25th.
August 25th. So in this case, when should I actually start depreciating it?
September 1st.
September 1st. So in this case, right, if my adjustments are done at the end of each month, okay, let's go ahead and start calculating everything. So depreciation basis, what should that be?
The 2485.
2485. Okay. 2485, right? It's not just only cost of the asset, it's cost of the asset minus salvage value.
Oh, minus the salvage value of 150. 2335.
2335. Okay, good. So that's my depreciation basis. Good. So then what should be my rate?
The 1 divided by the 7 years.
Good, which gives you a total of
0.14.
0.14, or in this case, if you actually expand it, it's actually 142857. Okay? So in this case, I have to use my equal round formula because I have a number that doesn't give me a very even number to divide. So in this case, right, I'm looking at 14.285%.
Mm-hmm.
So in this case, I need to solve for my depreciation expense for the month. So how do I do that? So what is this going to be here?
Depreciation basis. So the 2335 times 333.57, but that gives us for the year, right?
That's correct. Good. So good. That's for the whole year. Okay. I'm only looking for 1 month.
Yes. Divided by number 12. So 2780.
$27.80 is correct.
Accumulated would be the previous year, which we don't have, plus the current year, so it stays at 2780.
Good.
And then our book value, the cost of the asset, 2485 minus the 2780, 2457.20.
2457.20 is correct. Good. All right. So let's go ahead and solve for the second month. So in this case, what's my depreciation basis going to be for the second month?
It would stay the same for all 7 months.
It should stay all the same for all 7 months. Good, because even if it's years or months, the depreciation basis is not going to change at all. Same thing with the rate, right? Because it's all going to be the same. Now, what about my depreciation expense?
That will change. It should stay the same as well because the first two columns are exactly the same.
Exactly. In this case, we're not looking at the year, we're looking at the month. So in this case, even if you divide the whole thing by 12, you're still going to get 2780 every single month, right? Because we're doing it on the month to month basis, not the other way around. It's not a year to year basis. It's based on every single month. So in this case, right, let's go ahead and solve for the accumulated depreciation. Okay, so what is the accumulated depreciation for the second month?
So the 2780 minus 2780?
Not
Or do
minus,
we,
plus.
oh, plus. 20, so this one plus this one. 5560.
5560, which brings my book value down to
Cost of the asset
mm-hmm,
minus the accumulated depreciation. 24, 29, 40.
20, good, 29, 24, 40, okay? So then what's going to be my accumulated depreciation for my third month?
8340.
8340, which brings my book value down to
240160.
perfect. Okay. What about my accumulated depreciation for the fourth month?
11120.
11120. And what's my book value then?
237380.
237380. Good. What's my accumulated depreciation for the fifth month?
139.
139 even, bringing my
Yes.
book value to be
2346.
good. Okay. What about the accumulated depreciation for the sixth month?
16680.
16680, and book value is
231820.
And last but not least, what is the accumulated depreciation for the seventh month?
19460.
Okay. With the book value of
214040.
ooh, okay, I did not get 21.
Let me see. Oh, 229040.
Perfect. Okay, so that's a cool thing about Excel, right? We're able to produce the information pretty quick, right? All right, so let's pay attention to the next couple questions here. So it says here that question number 5 says record the adjustment entry for the month of August for the first year. So in this case, what would you journalize for August?
So August 31st. Depreciation expense.
Mm-mm.
Oh, adjustment entry.
When did we place the asset into service?
Oh, August 25th.
Okay, so do we depreciate anything in August?
No.
No. So in this case, that's a trick question for you to be aware of. That for the month of August, no, there's nothing that we need to put here. Okay. However, question number 6 asks, well, how about let's do the adjustment entry for the month of September for the first year. So in this case,
We would have the depreciation expense of the 2780.
correct. Okay. So okay, I think I messed up this date so bad. Because I put September 31st. There is no such thing as September 31st. Okay, so in this case, we have depreciation expense Okay, and we have the accumulated depreciation. Okay, and you said it was for the $27.80.
Mm-hmm.
Good. Okay. Now, question number 8 asks, well, if this was the case, if the adjustments were actually recorded at the end of the year, assuming that depreciation adjustments were done as of December 31st, what would be the adjustment entry if it was calculated annually? So if I had it, if let's say for example, right, I'm doing this on a month-to-month basis, right? But what if I said at the end of the year, if I did my adjustments at the end of the year instead of doing my adjustments every month, what would my adjustment entry be as of December 31st? Okay, if I placed my asset into service as of August 25th, right?
Mm-hmm.
How do I figure out what my adjustment entry is going to be as of December 31st? So exactly what we've been doing in the previous sections where we treated everything was at the end of the year.
Mm-hmm.
How would I journalize this at the end of the year?
So we would have the depreciation expense of the 2780 after the 4 months.
Okay, 2780 for 4 months. What is that?
The depreciation expense, that was the amount that we had after 4 months.
Mm-hmm. What amount should that be?
2780.
Okay, so in this case, I'm not asking on a month-to-month basis. I'm not saying fast forward, it's December 31st. What should you do it? Okay. In this case, like the previous scenario, right? If I treated the adjustment entry was going to happen at the end of the year, okay, instead of doing it on a month-to-month basis. So if I did not calculate this as a month-to-month basis, how would I have calculated it for the first year
Oh, instead of
instead of a
having the.
month? Correct.
Okay. So we would do. Um, it would be the 2,335 times the rate to give us 334.
Okay, so that's for a whole year.
Mm-hmm. Oh, but we only did the 4 months.
Correct.
So we would, instead of dividing it by the 12, we divide it by the 4 months. It's,
No, you would. Okay, okay. You wouldn't. Okay. Continue.
um, divided by 4.
Okay, so you wouldn't divide by 4 because you used it for 4 months, right?
Mm-hmm. So we multiply it by the 4.
Multiply by 4 and divide the whole thing by 12.
Oh, times 4 divided by 12. So it gives us 111.
111, and there's a few cents there. So in this case, right, because we did solve it on a month-to-month basis, right? By looking at this chart, I said that, well, I used it for 4 months. If I follow this throughout here, right, the total for 4 months gave me a total of $111.20.
Mm-hmm.
So that's the same thing as saying, well, if I were to treat this at the end of the year, right, I'm used 4 months out of 12, which still gives me $111.20. So your answer, yeah. Okay, so again, I could ask you either on a month-to-month basis or I can ask you as a year-to-year basis. In this case, this one is I'm just asking you so you know exactly what you're doing. So in this case, the first couple journals were on a month-to-month basis. Now the last journal is asking you on a year-to-year basis.
Okay.
Mm-hmm. Good. Last question that we have here is going to be an amortization problem. So we have here that we, on January 12th, you decided to purchase a copyright for $2,500 and its useful life is 15 years. So the asset that we bought is a copyright. Okay. How much was my total? How much was the cost of it?
2,500.
2,500. Once again, any intangible asset does not have a salvage value. Okay. Its useful life, 15 years. Mm-hmm. And when do I place it into service?
January 12th.
So assuming in this example here, I'm going to be amortizing it at the end of every year. So what does this tell me here that if I decided to amortize it as of January 12th?
We're going to account for it that same month?
Yes, we're going to count January all the way down to December. So in this case, what's my depreciation basis?
It's the same as the cost of the asset, so 2,500.
Good. Okay.
And then our rate is one divided by the 15 years, so 0.07.
Okay. If you expand, that should be 6666667, something like that.
Okay.
Okay. So then you have to use your equal round here as well.
Okay. So depreciation equal. We're gonna do expense. So the basis of the 2,500 times the rate,
Mm-hmm.
and then to 166.67.
166.67. So again, because it's the first year of amortizing it, it's going to be the same. So then what is my book value?
Value is the cost of the asset minus, it's the cost of the asset, the 2,500 minus the accumulated depreciation, the 166, so 2,333.
Mm-hmm. Good. All right. What is going to be the depreciation basis for year 2?
It's gonna stay the same.
It will stay the same all the way through. What about the rate?
It will also stay the same throughout the whole time.
Exactly. It will also stay the same, right? What about my expense?
That should stay the same.
This will also stay the same. So, in this scenario, we're only going to be solving for the accumulated depreciation and the book value. So in this case, what's my accumulated amortization for year 2?
So accumulated. So the previous year plus the current year.
Mm-hmm.
So 333.34.
Excellent. Which brings my book value to be
The cost of the asset. 2,500 minus 333.34. 2166.66.
good. All right. So then what is going to be my accumulated amortization for the 3rd year?
501.
501, which brings my book value to be
166.65. Oh no, I did that wrong.
No, I did not get that. Okay.
So book value, the cost of the asset
Mm-hmm.
minus the accumulated amount. 199.99.
Perfect. Okay. So then, what's my accumulated amortization for year 4?
666.68.
Okay, good. Bringing my book value to be
1833.32.
1833.32. Okay, and then last but not least, because I'm not going to have you solve all 15 numbers or all 15 years, what is going to be the accumulated amortization for year 5?
833.35.
All right, bringing my book value down to
1666.65.
166665. Good. All right, excellent. So, all right, last but not least, how am I going to put the adjustment entry for the first year? So let's journalize this right here. So December 31st, how would I journalize my adjustment?
Amortization expense.
Excellent. Amortization expense.
And then the accumulative amortization.
Good. Accumulated amortization. All right, for what value?
The 166.67.
166.67. Excellent. All right. So then let's answer the last question here. How are you going to record the adjustment entry for the second year?
It would be the same thing.
Good. It will be the exact same entry here. All right. Excellent. Any questions in regards to chapter 11.3 or 11.4?
No, I don't think so.
No, you did a good job. Right?
Okay.
So, with that being said, that is all I have for you today. Like I said, I really want to save